Hi, and welcome back to Money Managers, a User's Guide. I'm Nathan Peters. Today we are joined by a very special guest in Richard Simmons, manager of the Derby Street UK Equities Fund, an 8-year-old, long-only, concentrated stock picking fund targeting excess returns with a deep value investing philosophy. So, a rare bird these days, Richard. Welcome to our growing series of conversations with great money managers. Well, the fund we're going to discuss today is targeted at professional investors with a £200,000 minimum investment and quarterly liquidity, but you also run managed accounts for friends and family. So if people are interested in contacting you after our chat, I'll leave your details in the description box down below. So before we start, I'd love for you to give our viewers a sense of how you got to where you are now. I know you're a diehard value investor, as you actually wrote an academic study of Warren Buffett. So tell us a little bit about why you've chosen this path as an investor.
Yeah, I suppose it's fair to say that the path chose me. I came into investing entirely organically. I'd left a career in banking after about 11 years and didn't really know what to do with myself. But I started to invest my own money, and this was in the mid to late 90s, and became fascinated, as many investors do, of course, fundamental investors, with Warren Buffett. And I ended up pitching a book idea to the Financial Times Longman people, which they kindly commissioned. And I fell headlong into this torrid, emotional, and intellectual affair with Buffett. Wrote my book, and then became drawn deeper and deeper into managing money. Eventually, a friend gave me some money to manage. And then I became regulated and started making a living from it in 2001. And I've been working at it ever since, often 7 days a week, 10, 12 hours a day, but never really feeling like it was a job. Always fascinated. We'll talk a bit about some of the themes that I'm working on now, but certainly part of what I like about investing is that one is always developing, always finding something new to do, always under a rubric of value, which these days is a bit of a baggy concept, I suppose, but always something fundamental to do with the nature of the business. And so there's a pleasure of discovery and of reinvention in it as well.
Sometimes I've noticed that the value investors, the fundamental investors, have essentially found what agrees with their constitution in terms of the style. How can you be so patient with a strategy that has underperformed for 10 years, but has its renaissance, I'd say, in the last sort of 1 to 2 years?
Well, I don't like to blow my own trumpet, of course, Nathan. Far be it from me to do that, but we have significantly outperformed in the last 10 years in the UK fund. The stock market, our fund's been going for 8 years, in fact. The stock market is barely up in that time, maybe 12% over the last 8.5 years, and we're up 95%. And I just want to make absolutely clear that what we mean by value is not what Morningstar or someone drawing a grid would think of as value. We're not buying stocks because they have low PEs or low price to book or high dividend yields. We might buy those things, or we might buy stocks with very high apparent PEs. But in all cases, it's what I call value because we're buying stocks or making investments because we believe that the current price does not fairly reflect the future of the businesses and the future of the cash flows of those businesses. So it's always value, but it's not what is necessarily traditionally called value.
Understood. And you have three categories that you mention in your materials: liquidations, discounted assets, and growth. And could you maybe walk us through what you mean by these particular categories and some examples?
Sure. I'll keep it brief because there is a lot of material that we've put out there. But liquidations are companies that are quoted. They're nothing to do with bankruptcies, what they sound like. They're companies that are quoted that have been given a mandate by their shareholders to sell their assets and return the capital to shareholders. So they're often very healthy, they've often got cash. We have done about 15 or 16. We have one in the fund at the moment, but it's our largest position, called Electra, and they've published their timetable for spinning off their largest business this morning, and that is going to be done by the 2nd of November. So it's got a very, very short duration on it. And we hope that the value of the assets, once they're spun off or sold, will be materially higher than the price that we've paid. So that's a liquidation. I'll come back to the second category last, if I may, because it's a slightly capacious bucket, because there's several things in it, and there's probably a good example to talk about there at greater length. The third category you mentioned, Nathan, which is growth, very familiar to all of your viewers, I'm sure. But again, with an emphasis on value, which is to say we don't want to pay too much for an excellent business. It's difficult to work out what that is. And the largest position there is a business that you may be familiar with called Naked Wines, which is an online wine cellar. Big here, big in Australia, very big in America, growing at a fantastic pace, somewhat flattered or exaggerated or accelerated by the pandemic. Now moderating back to a more normal fast pace of maybe sort of 20% or so a year in turnover. And its economics somewhat disguised by its willingness to spend all of its profits on attracting new customers. The second bucket, the hidden assets, some of them are not very hidden at all. So I can't say we're famous, but among the people who know us, we were famously associated with a company called Dejan, which was a property company with very low gearing, which were able to buy a 50 or 60% discount to its net assets. And we just held it for an awful long time, 15, 16 years. And then it was taken private last year. I think we made 16 or 17% compounded. And that was a combination of the growth in net asset value per share, which was fairly predictable, routine, and the closing of the discount. And that's an easy example. The example I wanted to tell you about today, because it's a little bit more hidden, is a company that has been called up to now Morse's Club, but it's just in the process of changing its name to U, Money, the letter U. Money, for no very good reason, I don't think. But so that's a good thing to do. And it's hidden only in the fairly obvious sense that it has a profitable business and an unprofitable business. And we bought Paddy Power, for example, which is now called Flutter, about 18 years ago, and it had a hidden business, which was its internet business. It had a profitable retail business and telephone business, and that was obscured by this business that no one knew how to value. And this is no different. This is a lender, what used to be called a doorstep lender or door-to-door lender or home collected credit business. And that's a pretty old-fashioned business now, but it's very solid, profitable. Again, a bit deformed by COVID, but it continues to be profitable. And a new business, which they bought a few years ago and have been growing very rapidly. That's grown 3 times just in the last year in online lending, which is loss-making. It's loss-making for 2 reasons. First, because it hasn't scaled yet, and secondly, because they've been required to add provisions at a higher level than is normal because of the speed of the growth. But if you take out the losses of the digital division, which we expect to come into profit very quickly, probably within the next year, you've got the existing business at a very low PE, maybe 7 times earnings, and potentially a very valuable new business, which, I don't know what it will do to the value, but certainly increase the value. And that's once you take that to pieces, it's a fairly obvious hidden value. It's not something you'd find in a screen, and you're not something you'd find if you're not interested in lenders. This is an unusual lender, I should say, and that has very little debt. And when lenders get into trouble, it's generally because they're borrowers, not because they're lenders. The lending can go wrong, but it's the liability side that tends to go wrong in banks. And this business has maybe 20% net debt compared to its net tangible assets. A normal bank will have 10 times that, maybe more, maybe 30 times that is the ratio. So that's an example of a hidden value.
I'm interested, how much do you assess management of these companies, especially if there's a pivot like this to a new business?
That's a good question. Management is a massive part of the decision to invest, but I don't have a magical formula, and I don't. Usually, I don't even speak to management. I've listened to these people in this case speak at their presentations, ask some questions. I think you, unlike in life and in fiction as well, quality is revealed through action. So when you're assessing a business, when you're assessing a management team, you look at what they say, but most of all, you look at what they've done. In terms of capital allocation, of course, which is a popular Buffett theme, but mainly through performance, how they've dealt with problems. And so the last 2 years have been revelatory for all of our businesses, for all businesses. What advantages? Look at the airlines, and you see the different strategies that they took through the downturn, and some will come out stronger than before, and some have not come out at all.
Right. No, it's true. I wanted to just say that you mentioned the outperformance over the years of the fund. When we look at your monthly returns through our Venn factor lens, which typical a viewer of our channel will have heard about and is covered in other videos, the performance is primarily down to basically excellent stock picking. But when you focus on value, it also shows up in this factor lens, like you mentioned, it's sort of a rubric, as a willingness to invest in lower quality businesses. So maybe their earnings are cyclical, maybe they have low profit margins. How do you think about how this bias, which comes out in the numbers, might play out as we emerge from COVID? And first of all, do you agree with that?
I don't wholly agree with it, because I suppose it's implied in how I was talking about Morse's Club. It's not always possible to run a computer program over the accounts of a company and say that it's low quality or high quality. What is quality? Quality is in the eye of the beholder. Quality maybe they're in a high return on capital, but in Naked Wines and in Morse's, you won't see a high return on capital because it's completely obscured by decisions that management have taken. Tom Russo called it a capacity for taking pain. Capacity for taking pain. He was talking about large businesses like Philip Morris that could afford to start into vaping or whatever it may be and take losses. And that's what the management of Naked Wines have done, and it's what the management of Morse's have done. So while the businesses look probably to a computer like they're low quality, I would say that Naked Wines is exceptionally high quality. Morse's, with respect to them, is probably an average to high quality business, by which I mean it's historically not performed that well, but it's likely, I think, to turn into a fairly high return business in the next couple of years, but I can't guarantee it. But even if it doesn't, even if Morse's turns out to be an average business, we paid such a low price that I expect that we will make money anyway. And if it turns out to be a good business, we will make a lot of money. So it's really, I know this is very difficult to evidence, except through our results. But what we're looking for is for businesses that will be good. And that is a matter of judgment. That's a matter of forecasting. Forecasting makes it sound very scientific. It's not. It's a matter of judgment based on experience, based on the plans as laid out by the management, and how that may manifest ultimately financially.
Maybe the biggest example of this would be probably Jeff Bezos at Amazon, right? And how Munger has sort of done this to himself about Amazon and not recognizing the quality in the business.
Absolutely. Amazon, I think, is a constant or an example of a business that value managers or any sort of investor should be constantly knocking themselves over the head with. Not to remonstrate, you should have done this, but what did you miss? What did I miss? What did we as a community miss in 2001, and then again in 2011, and then again in 2021? And what we missed, for those of us who missed it, was this fantastic future. The future is not in the numbers, right? It's got to be extrapolated. But that is true of every business, Nathan. That is true of every single investment, other than perhaps a bond, where you expect it just to perform in the way that it says in the prospectus. It doesn't happen in equities very much. Oddly enough, the liquidations are the closest to bond investing that I've come across, other than just buying bonds, because you can set out a timetable, and sometimes the management set out the timetable for you, what you might expect not only in terms of capital return, but the timetable as well. So you can actually make a sort of model of that. Not always reliable, but other than that, investing is forecasting.
I'm curious if it's obvious that you're in the weeds a lot with the companies. How much does macro affect what you do? I just cognizant that this fund is a UK listed stocks only fund. The UK is in the middle of, I'd say, tribulations in terms of from a macro perspective. How do you negotiate such a volatile environment?
It's been tribulation upon tribulation, to be honest. It's been Brexit, or before that, fear of Brexit, fear of Corbyn, for those who did fear him, which certainly included a lot of investors, and now the pandemic and the experience of whatever it is that we're going through now, this supply chain issue, however you want to explain that. And I think 80% you've got to just ignore it, because you've got to think about the future. You've got to think about what's a normal environment. It doesn't sound like there is a normal environment from the way I've just put it, but there is. There is a regular business operating environment in which planes are allowed to fly, lorries are allowed to go across borders. And as I touched on in an earlier answer, Nathan, you can see how well businesses respond to shocks, and the best of them come out stronger than they went in. And there's been plenty of evidence of that in the Lehman crisis of 14 years ago, and now these crises. And there are plenty of businesses that are far, far larger and more profitable today than they were 15 years ago, and there are plenty of businesses that are far larger and stronger than they were 2 years ago. And I'm not saying that's the only test, but it does go to answer your question a little bit, which is the macro, by and large, and within some expectation of normalization, is not that important compared to the destiny that people describe for themselves. I can't remember the quote from Shakespeare, but the future is not in the stars, Brutus. It's in ourselves. We have these businesses are by and large making their own weather, I would say, and that's what you're looking for.
Got it. And so, do you pay much attention to the discount rate that you're using to discount the cash flows back and get a sense of the value? I imagine it's been that one question for value investors with rates so low is just, what's your margin of safety on the interest rate side?
I don't pay a lot of attention to discount rates. I sort of invert that question as well as Mungo, who who was quoting a much earlier thinker who talks about always inverting. I can't remember if it was Gauss. I certainly have in my mind, the back of my mind, that interest rates could be a lot higher. In my mind, interest rates are still 10% for some reason. I know they're hardly ever. That gives you some.
It's whatever your first mortgage was. That's what you think interest rates are.
Absolutely. I did live through a couple of inflations actually in my childhood and adult life. So to talk, what I mean by inversion is that I look to have some idea, completely regardless of interest rates, of what a business might look like in, say, 10 years' time. Okay? So if the business is making £1 million a year now, and I think it's going to make £10 million a year in 10 years' time, pretty much whatever your assumptions are about discount rates, they're not going to be that relevant to whether you think that's a good proposition or not. If you were a betting man, right, or a betting person, and you could pay a reasonable multiple, which could be 20 times, 30 times, 15 times, lower the better, we know that, and you think it's going to be making £10 million a year in 10 years' time, you've paid £10 million today, or you paid £20 million today, you're going to be making 50% every year on your cost in 10 years' time. Do you need a discounted cash flow to work out if that's good or not? Would it make a lot of difference? Would it make any difference, actually, if your discount rate was 0% or 10%? No, that's a good bet. It's only if you live in Venezuela and you think interest rates are going to be 50% that you would have to think, could this business, you could still make the bet, but you would have to say, could this business actually make £10 million a year plus inflation? And of course, very good businesses, almost by definition, are able to compensate for inflation. So that's another way of answering your question in a way, is that a good equity will pass on cost increases to its customers, or absorb the cost increases in its general cost-cutting nature, such that it will continue to make a good return on capital over the cost of its capital. That's almost in the definition. So I can't say it's not important, because there's always shocks, but it's not central to the way that I think about valuation now.
Got it. One other item I wanted to chat about, just as a supply-demand dynamic for the kinds of stocks that you look for. The press, is saying that the private equity industry has $3 trillion of dry powder committed capital ready to allocate. And the UK has, as you mentioned, kind of one of the most depressed developed markets in the world. Are you seeing quite a lot of activity with your companies in terms of buyouts?
No, not any more than usual. If you held say 30 stocks, you might expect every year or two for one of them to be unexpectedly bought. But that is exactly what that suggests. It's unexpected. I'm not truly a capitalist sort of investor. I'm a fundamentalist in that I believe that businesses will ultimately trade up to the value of their cash flows. If someone in the meantime, as happened in Dejan, for example, comes along and makes an offer for the company that's reasonable, that's cream. And sometimes it's not cream, it's just what you were expecting to happen at some point. You just didn't know which business it would happen to. So I don't think it's that useful to worry about. And I certainly don't think you should invest in a business thinking that someone else will come along and pay a higher price just because they're stupider than you or they've got more money than you. That's a losing strategy over time. So I think it's better to just take that as a bonus. But I haven't experienced an awful lot of it in the sorts of businesses that I've bought. No.
Got it. And just for the viewers, what are you most excited about in your portfolio right now? You mentioned some of your larger positions. Mm-hmm. Is there anything else that that you think has merit?
Well, the businesses that I mentioned, Morses, Naked Wines, and Electra, are they're they're the largest constituents. I suppose another one that I'll mention again is Flutter, which used to be Paddy Power. I mentioned we've owned it for an awful long time, but it's reinvented itself since those days of telephone betting several times. The internet, it was a great employer, early adopter of the internet as a new channel for reaching customers. I won't bore you because it's pretty obvious how that's a superior medium compared to telephones. Telephones were pretty good, by the way. I mean, compared to shops, there were things they could do with telephones that are amazing. They could recognise people's identities from the telephone number, put them through certain operators and so on. Anyway, they merged with Betfair. Betfair was a very good business. That was a good reinvention. And now they've got this massive opportunity with the deregulation of the American sports gambling markets. I call them markets because it's, as you know, it's state by state. And they're the largest player. DraftKings is more famous because it makes more noise, but actually Flutter is the biggest, through its properties there, it's the biggest player right now. It has about a quarter of the market. It's not profitable yet, but it's growing, as we used to say, growing like Topsy. It's growing very, very fast. And their existing businesses in the UK and Australia and Ireland and so on are growing and very profitable. But there is this additional, somewhat hidden asset in the sense that it doesn't appear in the accounts yet, only appears as a loss, which is potentially phenomenally valuable. Flutter is not a cheap company. Even if you write down that American loss to zero, it's not a cheap company. But with some reasonable assumptions about what that American business will eventually make, and I'm talking about 7 or 8 years' time, it's a fairly cheap business. So I say that's an exciting opportunity. But I like all of my children. That's why we own them. And I'm excited by Electra's spin-off of its biggest business, which is, I mentioned earlier, about to happen. I'm excited by Morse's turnaround, in inverted commas, and its ability to bring its new business into profit. And all of our big positions have that capacity to grow, I believe, well beyond their current profitability and well beyond their current valuations.
That's brilliant, Richard. Thanks so much for your insights today. Is there anything that we didn't cover that you think is important?
Absolutely not. That was fantastic. Thank you so much, Nathan. I really enjoyed that. I love talking about investing. I love thinking about it. And I love thinking about new ways to invest as well.
Well, that comes across. Thanks again for your time.
Thank you very much.